Good morning, everyone, to another Tuesday Wize Clinic. And of course, we're joined here by the excellent Selena, who's here to support and give resources and links and help you in any way she can. And our head of Wize Talent, Danny, good to have you here. Morning.
Morning.
Morning. And Chris, good to have you here as well. Wize Talent Specialist. At this point, I think you must have done like the both of you. I think I heard a crazy stat the other day, which was the Wize Talent's done something like 600 hires or more.
Not quite 600 yet, but we're getting there.
I
It's
swear I heard
yeah, it's
six
about three and a half, like 350 or something.
thousand.
No. Thomas, you're making it more. We've only been around for 5 years.
Okay, well, today's topic is a pretty fundamental one, and I'm gonna go ahead and just start to share my screen to this side. Okay, how's that?
Yeah.
Awesome. So today's a pretty fundamental topic on KPIs, and not just any KPIs, the Fab 5 KPIs. We're going to talk about what they are, and I know most of you here have gone through what the Fab 5 KPIs are, but we're joined here by two new members as well, so it'd be good to take them through it, and then we're going to talk about setting them up, okay, and then having it become a thing in your firm, right? And generally connecting that towards how do you make any new thing a thing in a firm, right? And so we'll get right into it. So today we're joined here by myself and Danny here to co-host. And if you want to follow along or access any additional resources, feel free to check out, save this file name, note this name down here, I guess, and then search that in the Wize Vault. Okay, and this would be under the clinic recordings, which Selena will be able to share. All right, so we'll get right into it, and I'm gonna demonstrate here by actually just going straight to the Wize Hub. Okay, we'll go to our awesome, friendly firm here, 23 Degrees Accounting demo account. Okay, so KPIs. All right, I've seen so many takes on KPIs in my time here as Wize Mentor over the 6 years. Accountants, we love our ratios. We love our tracking. We love our metrics. Sometimes we just spend probably a little bit too much of our firm's bandwidth trying to get numbers instead of working on them. But there's no question, when you see these, when you're able to keep track of numbers, you get that sense of control, okay? And what we're trying to teach here at Wize is how do you not waste your energy? Okay, and I think this is similar to the previous clinic on triage, which is not about wasting your energy. Here, it's about how do you focus on a set of KPIs that are actually important. And we have this one underlying principle that governs all of this, and that is it's about being output focused and oriented, not input focused. Okay, so what do I mean by that? I mean, you often would hear team members, or you might say to yourself, I worked very hard. I've worked 12 hours today. I've got 20 tax returns done. I've answered hundreds of emails. And these are all really good things. These things actually need to happen for the firm to function. But they never give you an answer to how are we actually doing? Okay, like did we do those tax returns profitably? Were the right people doing them? What emails were we answering? Did they actually result in the client satisfaction improving? Right? And you often hear also in marketing, people talk about how many views they get, how many impressions they get. And you hear the term vanity metrics. And what's really important is actually, are you making any sales from it? Are you actually getting any customers from it? So being output focused means focusing on the results, focusing on the outcomes, not the inputs. All right. And with the Fab Five here, these 5 KPIs right here, revenue, profitability, lockup, and sales and NPS, these have been refined over the last, Jamie would say like 10 or 15 years to give any firm owner a complete spectrum, full spectrum view of how their firm is actually going. Right, so I'll go over each of these KPIs here. It's first revenue at our top line, and we're comparing what we're doing currently year to date versus our performance last year to date, and then against our year to date budget. All right. The change here, growth, is our actual year to date versus the actual last year to date, and this variance is our budget versus our current year to date. All right, so that tells us, are we growing? Are we actually meeting our targets? Are we billing people the way we're supposed to? Are we actually charging for new work? Then we have our profitability. Here, cost of goods sold. We're showing cost of goods sold here and not overheads because cost of goods sold is something we can actually control. Okay, cost of goods sold actually outputs productivity. It outputs the revenue. And then we've got an EBIT as a consequence. Okay, so we've got EBIT here. That's after the COGS and overheads and our write-ons and off. Now, the write-ons and off I've seen is probably the hardest KPI for any firm to try and secure. All right, this is the hardest. This is the KPI if you don't already do timesheets or have some form of budgeting, job tracking system. Give yourself like 3-4 months to try and actually get this KPI. And so, what is this? Like, the rest are pretty self-explanatory. Being as we're accountants, write-ons and off is something I noticed that we don't really understand that well. Write-ons and off, it's all about how much time did we spend, what was the market value of the time spent versus the actual amount we charged that job, okay, or the budget of that job. So did the team's was the team's time spent in the job within the expectations of what the fees were or the budget? Okay, and you can measure this in a few ways. If you're an hourly charge firm, this is pretty straightforward. Okay, like this is, you build up your WIP, you invoice it out. If you can't charge a portion of it, it becomes a write-off. Sometimes you add to it, it becomes a write-on. If you're a fixed fee firm, then you would still track this, but what you're actually comparing is you're comparing your fixed fee versus if I had been charging this client hourly, right? The senior tax accountant at $180 an hour, the intermediate accountant at $140 an hour, the junior tax accountant at $100 an hour, a senior production manager's time at $200 an hour, a senior client manager's time at about $250 an hour. Like at those sort of, they're the current market rates. I feel like they should be higher nowadays, but that's the current market rate. If the team was charging those rates, if the engagement was hourly, would you have made more money just charging the client hourly versus your fixed fee? Right? Like, did you actually charge that client better than if you just went with timesheets instead? So that's what you're comparing yourself against when you're doing fixed fees. The challenge with fixed fees is that often we'd bundle a bunch of services up into a monthly subscription cost. And we'll do sales tax or GST, and then we'll do an annual tax, and then throw in all these other little bits and pieces. and then charge the client something like $600 a month. And then when you go to actually track this right on and off, it becomes difficult because what exactly, how much of that annual fee do you exactly allocate to that individual item, that job that you're doing for the client? Oftentimes we put this monthly subscription fee, we kind of like feel what we want to charge and we divide it by 12, right? In that situation, you actually do have to go and break that annual fee up into the individual jobs and then use that as the measuring point for the right on and off. Okay, and the easiest way is this. If you're an Australian firm and you're doing quarterly BASs and an annual tax return for a client, my math is not going to add up here, okay? And then you charge $5,000 a year for that client to like do the whole lot, you know, the individuals and there's a company in there. You might just go, okay, yeah, individuals have got properties, minus 500 out of that, each person out of that $5,000, it's got $4,000 left. Market rate for a BAS, maybe $500, that's about like $2,000 for them. And so you got $2,000 left for the company tax return and financial accounts. Okay, so that it's not going to be exact. You can sort of ballpark it that way, but at least you have something to put into your carbon fixed fee setting. You have something to put into the budget in XPM. You have something to put against that very specific job in your Excel sheet. Otherwise, you are never going to know if you are undercharging that client or you're inefficient with the job until the finish of the financial year. And that is way too late. Okay, so anyway, I'm going too deep into that part. That's right and on and off. And then we have this right on and off percentage, which is the percent of that versus the EBIT. So that number what we're aiming for is about 10% positive. And then we have the WIP balance. And our WIP balance is also another one that it's different for every firm. If you're an hourly fee firm, that's just really the total WIP you've got before you've actually invoiced it out. If you're a fixed fee firm, then you have two options. And then this is after you've actually proportioned out that annual fee to that job. You've got two options. Option one is you get the value of the work that is currently in progress minus the WIP if your firm had been charging hourly against it. And that kind of tells you, okay, this is how much work we actually have left to go, right? If you're using carbon, you can put in a budget and it's whatever the dollar value of that budget remaining is. What I like to go with is what the total value of the work that is in progress minus nothing. Okay, it doesn't matter if the client prepaid it or we've done work already. As long as this job is in progress, like as long as it sits on our desk and it's not lodged and completed and invoiced, I don't want this number changing. I don't want to like offset it. I don't want to like minus it. I don't want to make it look as any better than it is. Until we finish the job, we're not even entitled to the money anyway. So I like to leave that number just a clean sum of it's all the jobs that are from ready to start, meaning we've got the information, the client's signed the proposal, the job could very well start all the way until completed, all right? And that way the teams are actually accountable to completing the work. Because, you know, like people can put time into work. It doesn't mean the job is actually completed. So anyway, that's WIP balance. There is an official benchmark for this, but you're aiming for somewhere about half of the average monthly budget that you do. Okay, so if you're a $1 million firm and then average it, that's like 83,000 something every month, then your WIP balance, you're aiming for something like 40,000. and meaning like you've got about a 2 week turnaround time. You've got more or less, you've got like 2 weeks worth of work in front of a new client coming in. Okay. And then we have debtors balance, money people owe you, the revenue and number of days in a year, this WIP balance and debtors all come together in this formula I don't remember to give us lockup days. Right. And this number we're aiming for being below 14 days. The revenue and profitability, we're doing it on an accrual basis. Okay. Like it's on an accrual basis. Otherwise there's no such thing as a debtors balance. And we want to see how much we've actually invoiced and then how much we actually have to collect. Okay, and so that's lockup, our third KPI. Pretty standard so far. And then we have our sales. Okay, we're starting to step outside the P&L and other financial metrics over to sales. We've got prospects to client percentage 1. In Wize, there's leads, prospects, and clients. A lead is someone who hasn't. Everyone's definition is different, but I kind of find that firms draw the line at whether to count them as a prospect, depending on if they've done a discovery meeting yet or not, or received a proposal. It's up to you. So a lead is someone who hasn't done a discovery meeting or received a proposal. A prospect is someone who has done a discovery meeting and or has received a proposal. Okay, and percentage of those that turn into clients. The benchmark here is 50%, and it seems really high, but these are people who have received a proposal. These are people who have done a discovery meeting. It's 50% to also become an KPI to the marketing to qualify, like Division 2 and Division 6, to actually put effort into qualifying the right people before the senior client managers and client managers see them. Their time is very expensive and short. Then we have our fees won and lost. What this is measuring, it's up to you. You got 2 choices here. So I guess this is what we mean by customizing the Fab 5. You can either decide to only recognize in fees won and lost annual recurring revenue, your ARR, or you can just recognize all new revenue. Like even if there's an existing client doing an entity setup, you might want to recognize that as well. My personal opinion, it's better to do annual recurring revenue because the way I see this fees won and lost and this net fees is it's supposed to help you look ahead and forecast what your team capacity needs to be. Okay, so if you're an $800,000 firm and you have built your teams to the point where it can service those 800,000 in fees comfortably with a little bit of breathing room, and Damien and Opa, you will learn this over time. It's 10 to 15% is the surplus we want in additional labor versus the revenue that we actually plan to do. But suppose we're an 800K firm and we've got the team nicely made for 800K, and then the net fees won is 200,000. Or it's $50,000 after 1 quarter. Now, the typical senior tax accountant at 85% productivity at something like $180 an hour gives about 180 grand worth of capacity. So that says to you, okay, look, if I keep up with this growth rate, I'm probably going to need to start a hiring process in the next quarter. Okay? And given this current labor market, you could probably start now. And it sounds really early. Like, why start so early? It's not that you actually need someone in that seat straight away. It's just so you can have a really, really, really long time period in which you can review resumes, you can do interviews, that you can actually conduct selection and then find the right person. That's what they mean by hiring slow. Okay. Hiring slow doesn't mean hire as late as possible. It means you kind of see it coming out a long way, and then you do it very slowly so that you can pick out the right people and give yourself an allowance for that person you pick not probably working out within their probation period, and you have still a handful of good candidates that you can still hit up. This will save you from having to hire because the team is complaining, because suddenly a big job came into the office. Okay. It lets you see out further in advance. So this is for managing capacity. But yeah, so that's how I mainly would look at it. And we use it in board meetings. However, it's just also nice to take a look at net fees one. All right. And fees loss is also a red flag. If the reasons for the fees lost are anything to do with the client's satisfaction, sometimes you'll just lose clients because they close businesses. That's totally normal. And then the last KPI here of the Fab Five is the NPSs. The NPSs ask the question, on a scale of 0 to 10, how likely are you to recommend our services, our firm, to your family or friends, or to be a client with us, or to work with us? Okay, and you're aiming for a 9+ out of 10. When your client NPS is a 9+ out of 10, your clients will actually go out of their way to promote you. Any lower than that, between say 7 and 8, they're kind of like neutral about it. And anything under a 7, they're going out of their way to speak poorly about you. Client NPS getting to a 9 fulfills the first of 4 recommended growth strategies that we teach here at Wize. The 4 being referral, monetization, digital marketing, and acquisition. But to actually fulfill referrals as a growth strategy, it's about achieving a 9 out of 10 client NPS. Okay, so the first growth strategy is make sure your clients are really happy, and then track if they're happy, and then get the testimonials. It sounds silly, but it is actually quite a difficult thing in our industry. Okay, we're very busy. People asking us lots of things all the time, expecting quick answers to complicated questions. So this is a challenging metric for our industry, and it's worth tracking. I think we've all been there where you would hear from a new lead or a prospect, and you might ask them, why are you leaving your previous accountant? And they would often say, I would send them an email and they wouldn't get back to me in like a week or 2, or that accountant wasn't productive enough. Okay, so answering client emails and being proactive is already going to give you an edge in this industry. I'm not trying to make it sound simple, but that really is the thing to aim for. So that's our first growth strategy. And there's also no point monetizing extra fees, doing digital marketing, acquiring another practice if we can't even keep our existing ones happy in the first place. And then we have team NPS. Team NPS is, I like to think about it as the morale of your army, and in which you're like, I don't know anything about the military. Maybe you're like a captain or something. And then if your morale is low, in battle, your troops are just going to find an opportunity to shoot you. Okay, they're going to mutiny. Or maybe you're on a pirate ship, they're going to mutiny, they're going to throw you overboard. You might tell them to do something and they're just not going to listen. The emotional bank account, as we call it, is low. So you couldn't even implement a daily huddle with them, let alone say a deep and narrow team structure or a new project management software, if the team NPS is low. If your team NPS is a 9+ out of 10, well, you can be working with your team to implement things like the timesheet, weekly tacticals, the roles, and they'll listen to you. They'll actually be there with you. They're bought into the firm. So this KPI is pretty important. Team NPS, if it's like traction on the road, if it's not a 9 out of 10, nothing you want is going to happen. Okay, it won't actually happen. The firm will just go and do whatever they want, and they're not already happy in the first place. Now, that was like a very quick run through of the Fab Five. How these actual KPIs come together to tell a complete narrative of where the firm is at is the real value. Okay, is the absolute value. And now let me go through a few scenarios here. Suppose that you're looking at your Fab Five at the end of in a new month, in a monthly board meeting. And you're looking at a team and they've got a high WIP balance. Okay, they've got a high WIP balance, but they've got write-ons. Okay, so like they're actually doing the jobs within budget, but they've got a high WIP balance. What does that possibly mean? You know, what could it possibly mean? It means that, well, maybe the work is really large. Maybe they're stuck in a lot of admin work, a lot of non-billable work that's in front of their way. They're not able to actually get to any productive time on the job itself. Okay, so the team is efficient, but there's something blocking them. It's not to do with the team. You can't point your finger at them, the accountants, and go, why can't you do a tax return faster? They're actually doing it very well. It's a write-on. Something else is happening. You would put your attention into the other parts of the firm, like in Division 3 or in Division 6. Maybe there are client queries that just never get chased up. It's just stuck. Time's not getting added. It's not getting any less. It's just not moving at all. Say you've got a low WIP balance and there are write-offs. So there's not a lot of work happening in the office. And when it does happen, the team is actually going over budget on it. Sometimes when I see that, it's also correlated with a high cost of goods sold, above 40%, something like 50%. It's also correlated with surplus capacity that exceeds about 20%, 25%. And when I see that, and I've seen almost every scenario here, but when I see that, I think of I forget his name, it's like Ron Dennis or something, one of the bosses of McLaren F1. He said, work expands into the time that it's given or the space that it's given. He didn't say that, but he quoted someone that said that, in which I remember. And to me, what that says is people got too much time on their hands. There's too much excess capacity. Not a lot of work sits around, and when it does, it kind of just gets dragged out. It gets dragged out. And then the high cost of goods sold, along with the surplus capacity, indicate you just got too many people, or they're positioned wrong. Okay, a lot can be told about how the firm is going when you have all these 5 KPIs together. It always tells a narrative. These are output KPIs. These are the results of things that are happening in your firm. When you see things fall below a benchmark, then you start drilling into it. Okay, when you start seeing write-offs, then you go, okay, can you guys pull up your write-ons off report? Can you take me through the reasons? Oh, you don't have any reasons? Can I take a look at the timesheets? Oh, we weren't doing the timesheets correctly. So I'm just gonna have to guess at it, but if you haven't done it properly and it's a write-off, I don't know how the write-offs will get better if you did do it properly, because there'd be more time on there. So you would start drilling into the input KPIs, like the variables and the factors, only when there is a red flag here. Okay? And what you're looking for as a leader of a firm is that the managers are able to give you a reason and an answer that is consistent month to month, and they are clear on exactly what they're going to do about it. And then you would be comfortable. Even if the KPIs are bad, it doesn't mean you're going to keep feeling bad. It's just a cue for you to drill into it and interrogate the managers to ensure that they're across it. If they're across it, you can kind of relax because like, okay, you know what's going on. You had a client's this and that, and all right. And what are you going to do about it? You try and force them to take a bit more control over the situation, turn it into an action item, and then that's it. And if that's consistent month to month, and if the numbers are explainable, there's nothing to worry about. You can relax as an owner. You can kind of like release that anxiety. All right? You can release the anxiety and that stress and then focus on back on growth. If you're asking your managers about these KPIs and they don't know what's going on, then that's when you start to worry. Okay? Then you ask them, well, okay, well then let's kind of dig into it together because these are your KPIs to own. If all the KPIs here are met, okay, if everything here is hitting its benchmark, you're meeting your budget, you're doing write-ons, you got net sales fee 1, you got client NPS 9 and team NPS 9. What you need to do as an owner is leave the team alone. Okay, like you need to train psychologically your team that if you're hitting your benchmarks here, I could come to you with all the suggestions in the world and you have a right to tell me to go away. Like, just go away. Like, clearly everything is under control here. We're hitting all our targets. Go do something better. Okay? The team has the mental space to go, we've got it handled. You can go do something else. And it's in training ourselves as owners that if everything here is fine, we kind of just need to relax. Like, things can always be better. You can always make a 30% EBIT a 40% EBIT. You can always achieve a growth target beyond whatever it is you plan in order to achieve the budget. You can always make any of these numbers better, but it's just about learning when to let go. Okay, so in both cases, even if they're doing poorly or not, it should give you a means to just psychologically like disconnect and then go do something else. Now, so yeah, how frequently should you be reviewing these KPI dashboards? You should be reviewing them once a month with your managers. Okay, so this, at the end of every month, at the start of the new one, you would do a monthly managers meeting where you would have your senior client managers in that room together with you, and then have them walk through the Fab Fives themselves. Like, teach them the same way here in Wize we teach firms what the Fab Five is. Teach what the Fab Five is to your team and get them to explain the numbers. And then you focus on asking follow-up questions and then just listening. Okay, it's how you get a manager to take accountability for results. And then putting it into monthly manager meetings is how you make it become a thing in the firm. I think you had a question on Facebook, Hank, which was how do you reward people for doing their timesheets, right? The thing is, when you start, when you want to enforce something or when you want something to become a habit and then something that the team thinks about every day, make it a recurring agenda as part of a meeting rhythm. And just never ever skip over it. Always be bringing it up. Always have it, build up this habit so that managers think in the back of their head, the month's ending, I'm going to have to explain myself for what these numbers are. And that they're going to be ready to actually prove that they know what's going on. Okay? Any questions? I touched on a lot of things, like quite briefly, like what the Fab 5 KPIs are, options that you can take in them, how you put them together in order to communicate a scenario, when you are able to disconnect yourself from this and stop stressing, regardless if the firm is doing well or not, as long as it's explainable or if they're hitting the benchmark. And then how to actually make it a habit, which is putting it in a monthly managers meeting and then getting the senior client managers to take ownership of it. It's a lot there. So if you've got any questions, Oh God, sorry. My chat thing was all the way on the other side there. I didn't see that. Sorry. It's like edit. Uh, okay, Damien. Because you asked the question first. How do we get the staff NPS? All right. I actually recommend you got two options. You can just take your every Microsoft Forms or Google Forms and just have that question, 0 to 10. How likely are you to recommend your family or friends to work at our firm, and just send it out to your team every month, and then take the NPS of that score. Or you can use this app here called Office Vibe. But you know what? There are probably better ones nowadays. But people in Wise have been having a really great experience with this tool. It tracks the NPS and it gives you this overall engagement score. And depending on every week or fortnight or month, it will send out to your team a set of random questions that come from a set. And then you get these breakdown questions like relationships with manager, um, all these other bits and pieces. And then kind of gives you a bit more detail into what the actual team is feeling. That's Office Vibe. It's pretty good. And Edit and Mina and Hank having a good conversation there. Did you want to share about that? Edit, your write-ons and off being your poorest stat. How's it frustrating you?
So I'm running a slightly, same concept, write on, write off, but basically I'm running this is how much you should be charging based on your charge out rate rather than fixed fees. And we're constantly on certain jobs running at 60, 70%, which basically tells me that senior people are doing work that they shouldn't be doing, which
Yeah.
really frustrates me because you're kind of leaving money on the table. So it's all fine and well that the job rate works out fine, but actually this is the maximum we should recover from those hours is not working fine at all. So yeah, that's a very big frustration of mine.
So you drilled into it and found that it was because your managers spend more time on the work?
Yeah, the managers are doing time that should be delegated is one issue. The other issue that transpired was actually to do with pricing, which is the manager wasn't increasing the pricing in line with the client growth. So we're trying to cover more transactional stuff for the same fees, which of course will erode the margins. But is the combination of those two is like just frustration.
It's those two conclusions there prove how important it is to track it, the right ons and off. It is probably the most important KPI, in my opinion, amongst you could do net fees and write on and off as the only KPIs. To me, that's the most two significant KPIs on this Fab Five. But yeah, and I see that quite often at it. In most firms, the managers are working the hardest. And the team members aren't. It's always the managers that are doing like 110% productivity, and the team members aren't. I guess because our industry culture is we promote the people who work the hardest and who are the most capable. We don't necessarily promote people who are okay at it, but then really great at training people and then handing out the work to other people. So we don't train people to become managers. But yeah, that pattern is definitely one I've seen a lot. And the undercharging of the clients as well. Sounds like you have an SOP there to increase the fees based off the growth of the clients, which is great. 'Cause now you have a way to hold people accountable. How long have you been tracking the write-ons and off in your firm?
Oh, quite some time. So I'm going to say several years. Please don't shoot me, but I've been tracking it for several years. But I made a very, very, very stupid assumption, which was that if you look after a client fee base, you look after your recoveries and you look at your recoveries and take corrective action. And 3 years ago, I was like, well, actually, something's not right here. So I aligned the prices and I assumed that the message got through and it was working fine. And basically, I just found that our margins were eroding again, and I'm like, what's going on? What's going on? What's going on? And yeah, then I found out that maybe I should have kept more of an eye on it. So it's on me.
Oh, but it gave you visibility. And that's more than,
I've always had the visibility. That's not the problem.
yeah. But well, yeah, but sure, every firm will have, work needed to get the team. It's hard for a client manager because their nature is to please the client. And we've all, like, every owner has been there. Like, their nature is to please the client, and they develop relationships with them that almost look like friendships. So it gets it's one of our weakest qualities in the accounting industry. But that's awesome that you've been able to at least show them that this is affecting the margin of the firm. If you expect a pay rise at the end of the year, I don't know where I'm going to get the money for that if we don't actually increase the prices. But that's all. Did you see it correlate with? I mean, you mentioned margins, but did you see it in the client NPS? Was like the clients were they happier for it, or
I couldn't tell you because we actually have got quite a high client retention rate. So I don't think that generally there was an issue with client service levels. And I don't think that any clients became more loyal because we were stupid and didn't charge them enough. So I don't know. I don't think that our NPS score would have increased because of that. No.
okay, it's just a thing. Yeah,
I agree.
Hmm. Okay, well, thanks for that edit. And Mina, you shared your experiences um, increasing prices in response to dealing with write-offs. And how did that go? To share for the benefit of the room, if you don't mind.
Hey Thomas.
Hey.
Similar to edit, we didn't have a visibility problem. We just were uncomfortable, right? So we were scared of how the clients would respond, or and we didn't feel that because we were so busy, that we were providing like top-notch like service to warrant the increase, if that makes sense. So we resisted for probably a decade in that journey, Thomas. Um, but we found that most of them, if we segregated them out and then just sort of honed in on, this is the client meeting we're having, we're going to discuss how things are going. We just followed a prompt. Um, you know, what are we doing well? How are you finding our services? Can we be doing anything more? Because sometimes in that more, they might put up their hand, and that makes the repricing conversation a lot easier because we're adding and repricing the scope of services. But overall, the bigger ones, there was zero fall off, and it was the smaller ones where we were never going to be able to keep them happy. We were never going to be able to increase the price. It was never fast enough. It was never, cheap enough. So, and those ones, they just naturally, we're able to replace them so easily, Thomas, in the current market, because there's always clients putting up their hand and wanting to go to other firms. And then because they dropped off, we find ourselves like, even though they were small, they occupied so much time. Like they would want everything done outside of our system. So we wanted to do everything electronically, everything through the programs. And they're the ones that are like, no, I don't want that. I just want to keep sending you an email, or I want to keep posting you stuff, or whatever it is. And the time capacity is increased. Yeah, so I don't think even if we knew what the write-offs were, we just didn't do anything about it fast enough because of the uncomfortableness.
Right. It's so uncomfortable to sit down with a client and have them rate you, like tell me how we're going with you. Are you happy or not? And it's so true. 20, I guess the 80-20 rule, 20% of the clients also give us 80% of our problems. And 20% of our clients give us 80% of our revenue. But the 20% who give problems, correlate with the lowest fees, even. So, good job being able to identify them, using the right on and off as a trigger point for that, and actually taking the courage to actually get in front of them. Hopefully that helped everyone. And Hank, did you want to share how you started using Carbon to send out weekly reminders? Uh, is that for your timesheets, or do you want to go ahead and share?
And so we use them for timesheets, and we also use them for updating the workflow too, because a lot of people don't update the workflow, so they don't actually like complete the work, the project when they're done or move it to the next area. So we've been working on that, doing weekly reminders, using the automated weekly reminders with Carbon, so that way we don't have to constantly remember to do it. And it's helped out a little bit. I mean, there's still always, we still have to do retraining and still remind them a little bit, but we only started it maybe a few months ago, so it's helped out a little bit more.
Good stuff. Good, good using the system you have to reinforce it. So in everywhere we can, use reminders, use the weekly meeting rhythms to be able to have it become a habit. Ed would have said it takes 6 months to get rid of an old habit and then 6 months to implement a new habit. Right? So that's it's a good thing that you put that in place. Joy, you said, does anyone have a questionnaire sample for NPS? What questions to ask? I'll put this one in the chat. The NPS question. So you can put that question in like any form. With the client NPS, you can bulk send it to all your clients twice a year. You don't have to do it at the end of a job. You can just send it to everyone twice a year, your existing clients, and then your team, you can send it to them monthly. Right? I would say, hopefully that helped. Who here has been in the process of implementing the Fab Five and is kind of stuck on like one or two of these things here? It's not sure how to quite get that NPS, like that number itself. Oh, good. And who here reviews their Fab Five monthly with their managers already? Okay, that's probably something to start. Aaron, maybe I'll put you on the hot seat. Do you review, well, you didn't put your hand up, but like, would you start reviewing your Fab Five together with your managers? Because I know this is an area where it can get sensitive because, you know, teams are seeing numbers and yeah. What are your thoughts on that?
Yeah, I think it's a good idea. We don't do it, but it's definitely something that we're looking to implement because yeah, we're noticing that there is a lot of work being done on jobs by managers where it should be being pushed down to juniors. So,
and how did you notice that? What numbers?
Our whip's just getting a bit out of control, and we've also been looking at our total employment costs versus our revenue, and we're probably about 1.6, which needs to be a bit higher.
Was that a ratio?
Yeah, so our total employment costs.
Oh, that was your wages cost divided by your gross profit, that ratio?
Yeah, our revenue, yeah.
Oh, that was the like simple numbers or something ratio.
Yeah. So we're sort of looking at more, trying to get that up to sort of 2.5 to 3 times.
Yeah.
So I think we have a lot of pickups, put downs, which is causing inefficiencies. So it's sort of taking too long to do jobs.
right? So it's surfaced through the high whip balance, and
Yeah.
it's very visible, right? Like it's just
Mm.
work. It's just work sitting around. You can see it on our lodgement list. It's the one thing the
Yeah.
ATO also kind of helps us. Like, hey,
Mm.
these still aren't done. Gives us
Yeah.
a percentage to track as well.
Mm.
Yeah, managers delegating down is the biggest thing. So hopefully, when they take ownership, if it's like, yes, we should be training them to be better managers and then telling them to delegate the work. Having them take ownership of the Fab Five creates the need for them to do it. It's like, well, now you're just going to have to be explaining this to me and what you're going to do about it. And if there's a red flag in here with this whip balance, you're going to be reporting weekly. What exactly does the team have to do? Like, what is the issue? And it's really easy for us also to sit there and go, you need to do this, you need to do that. It's always a lot better if you know the answer to see if you can ask your managers in a way where it comes out of them. Like they kind of just tell you, yeah, I thought that was the case. And then them beginning to take ownership of it and then saying that this is here to help you. If these numbers are all great, I'll leave you alone. Like I don't even want to be nagging you about it. I don't even want to be thinking about it. So yeah, this will be good to put in front of them. Some owners might find an issue with the team seeing profitability. The way I put it is, we expect at least an EBIT of 30%. And if we're not a win-win-win for the clients, the team, and the shareholders, well, the shareholders aren't winning. Well, we just sell this thing then. What's the point of stressing about running a business if you're not going to be making any money? So everyone can just, I guess you can go find a manager position at another job or something else. So it's there. You can think about it. The cost of goods sold is the team's EBIT, like so to speak. Things have to actually be balanced. Okay, so if you the key the thing to tie this all up is you want to be delegating to someone in your firm to be completing the Fab Five for the firm. Okay, that person could be an admin person. It could be a internal bookkeeper, accounts payable, like just it could be anyone, right? But this is something to be delegated and then prepared for you, in which your team and all your managers are going to present to you every month. Okay, that's kind of where you're trying to head with this. You're trying to get the team to report these numbers to you, right? It's not you working really hard to try get these numbers done and then you look at it. Okay, you should be spending 80% of your time interpreting and then questioning and trying to understand these numbers versus putting them together yourself. And they don't even really take that long anyway. Okay, so that's giving the team the means to report to you on performance, okay, rather than just hearing like random bits of good news and bad news that they're trying to share with you just to pass the meeting. Okay, thanks everyone for joining today's topic session on the Fab Five. It's a lot in there. It's really hard not to go into detail in any one part of this. And I know if you've been part of Wize already, you've heard us go over the Fab Five again and again. In that case, just focus on making sure that it stays delegated and then interpreting these numbers in different ways. Like, just as a thought exercise, take your Fab Five and just imagine that the numbers were different. What would that mean in your firm? Okay, like think about it this way. If my firm was not finishing work, or if my firm was not growing, or if the team was unhappy, if we weren't closing clients, what would that look like? What would your Fab Five look like in that situation? It's something to think. It's not, I would call that a quad 4. to be honest, like almost like a delete. But it's just being able to prepare yourself to recognize when there are actual red flags. But there's not really anything you need to do. But yeah, from this, if anything, from today, imagine, you know, if your numbers were different, what would different scenarios look like in numbers in your firm? Okay, I hope today was helpful to everyone. Even if you've heard of the Fab Five before, Damien and Upar, did today's session on the Fab Five make sense to you? Did it? Do you see it applying and actually helping in your firm?
Yeah, definitely.
Great. Great. Okay. Thank you, Aaron. Thank you. Great. Oh, well, yeah. So if you want to work with a Wize mentor, starting with your Fab Five, interpreting it, implementing things, talk to Christy and she can talk to you about a Wize GPS, which is like a business plan, looking at your firm and seeing where it currently is and helping you make a plan on where you want to take it. And Danny, you want to say anything, Danny?
Oh yeah, sure. I wasn't sure where you were going with that. Yeah, so if you need help with the hiring process, and I always say to clients, don't leave the hiring process until you're desperate, because that is when you'll start making the wrong decisions. But yeah, so if you need help at all, please feel free to reach out. I just put in the Calendly in the chat. And yeah, I'm more than happy to go through our 47-step hiring process with you. That's it.
Thank you, Danny.
Thank you, everyone.
Thank you, everyone.